What's up guys, it's Michael here. In this video, we're going to talk about why investments always rise. Meaning, we're gonna look at the two main sources of investments of today and majority of people can relate to. So the first one is stocks. As everyone know, and in this channel and other people's channel, stocks are a major player in investments. Number two is real estate. Those are the main two. There's a lot more other types of investments in there, but we're going to discuss those in a future video because not many people can relate to like bonds, investments in like vehicles, investments into different types of categories. It can branch us out. So anything that comes back and gives you a return when you put money in is considered investment. But the main two that majority of people know and now are just getting bigger and bigger and bigger, and you're looking at basically how people can change the market is looking at how you can smash the like button down below. If you click the like button, good for you. If you don't, well, shame on you. So let's get back into it. Why do investments go up? So there's many other factors, but we're gonna look at the main two. So first one is people say it's artificially inflated, meaning someone's manipulating in the background. That is true, but there are many other factors. So one, you gotta look at manipulation, artificial inflation. So basically it's not natural, that's what they're trying to say. But look at many things of today, many things are not natural. And number two, which is you gotta look at how the platform is built, meaning is how the economy is set up, how the way the system works for generating revenue. So those are the two main ones when you look at investments. So let's get into it. First, you gotta understand where the stocks originated from. So they originated back in the 1900s, moving up. Companies decided to go IPO. So the government let people buy in shares of that company when they go IPO. So when they become public traded company, other people can see information about them and they'll invest accordingly whether they think the company is profitable or not. And now and today, so thanks to the internet, it becomes more and more mainstream. So more companies are now popping up left and right. Then you ask me, Michael, how's that even feasible? What happens to companies you invest in crash? That's why there are companies now, what they do, they get something called index funds. Or like you look at the S&P 500, VT Sachs, what they do, they take the top 100 companies and you buy fractional shares of them. So you put like say $1 into, which is not possible. Let's assume $1,000. You put $1,000 into an index fund. So they take that $1,000 and they buy fractional shares. So you have one share, you buy a portion of it and you split it up of the 100 companies all equal to $1,000. So the interesting part is, you look at the economy. How does this play back to the economy of the United States? So whether it goes up and down, we'll cover that in just a second. So you look at what happens if one company falls within the top 100 companies that went IPO in the world. And the reason why is, when one goes down, another one will take its place. That's how it works in the stock market. One drops, someone else comes in. As simple as that. Because someone finds another opportunity to step in the boundary and they come in and take that spot. So that's why companies always have to be on edge, meaning those companies are competing with other people. When there is no competition, then people will basically stagnate. For example, you look at the computer market. You look at Intel and AMD. So back then, AMD was a piece of garbage. And now, 10 years down the line, they started catching up slowly and slowly, all of a sudden out of nowhere in 2020 and 2021, they pop out of nowhere and kick Intel's butt. And you look at that, what happened? They had competition, but the only competition is AMD and Intel. One of them got really lazy because they knew the other competitor was, they didn't have a chance. That's what they thought. But slowly they inch back up, get closer and closer, and they just basically pass them coming from behind. A sneak up. So that is what happens when there is no competition or little competition. And of course, you get into, monopolies and duopolies where companies are working together. And that is not a good thing too. Sometimes having a monopoly is a good thing. For example, Tesla, because Tesla is considered a monopoly. And how does it relate back to stocks? Because when you have another company that comes in and disrupts the whole entire system, if you look at more financially how the car market is and how it relates to stocks, because all those car markets, they have stocks, but they're pretty stable. They're pretty stable. They don't really go up. They don't really go down. They kind of just level out. Maybe they do go up over time, but it's very slow. Because you look at it, they're all kind of working together. You kind of look at that as a duopoly. So when something like that happens, a bunch of companies working together as one giant corporation, as a duopoly, then you have a monopoly like Tesla come in and disrupt the whole market. So that's a good thing too. So there's good things and bad things between the two, depending what the situation is. And you gotta look at, why do stocks continue to go up even as of today? Like, it suddenly dropped because you look at it, this is based on facts and graphs where they did studies on how the stock market works throughout from like the 1980s all the way up to today. The interesting is, as technology grows, as companies evolve and new things keep coming out, more and more people are interested in investing. And you look at every 10 years, there's always a major catastrophe. An example, a pandemic, the housing bubble burst, .com bubble burst. You look at it, it's about every 10 years. When that happens, stocks will dip. But the interesting part is, if you look at the history back then, every time it dipped, give it a year or two, basically at least like 5 years, and also it skyrockets back up twice as high as before, which is insane. Because people, they realize that every time when that happens, this is the most millionaires are made. And why the stock's gonna go up? And here it comes in the other one, artificial inflation. Meaning that it's artificially inflated. Someone is manipulating behind the background. But at the same time, there's so much that they can do. At the end, it can all depend on the people, how they're willing to spend their money. So you look at it now, the current housing market. Why is it selling out so fast? Because people are now realizing, because companies, you can look at companies as a manipulator here, are moving out of state because they want a better friendly, terms of service or contract with the state. And the state, maybe like California, for example, is giving them a hard time, so they don't want to deal with it. So that 49 other states to pick from, they move out. So they move out, they take all the employees with them. When you take all the employees with them, stocks will fluctuate based on whether the people buying in think is the right decision or not. And most people, as you can see, they think is the right decision. And in that case, the housing market, they thought the housing market was going to crash because, mortgage rates back then, they kept it stable. All of a sudden, they decided to drop it close to nothing, getting close to 0%. So when they do that, everyone who has money are now coming in, swooping up the housing market. If that's the case, and as a real estate investment, you look at it, it's very difficult. And for example, if you want to buy a house and you're not one of those multimillionaires that are willing to fight for one and bid for one, you're basically out of the game. There's no way you'll get one because everyone's fighting for one. So that's why it inflates the housing market thanks to lower interest rates. And that is considered artificial inflation. So basically, if you have money, you can play the game. If you don't have money, you can't really play the game. You have to attack it in a different angle. Meaning is, are you willing to make the sacrifice that you're willing to make a crap ton of money now, and just basically in trade, you lose your privacy, for example, your house. So your house, in today, it's skyrocketing up because everyone's buying and there's, supply and demand. If you're willing to wait a few years and basically live in an apartment or condo, sign a lease on them a year or two, and you can buy back in when the housing market goes back down, because there's no way for them to keep the prices this high. Eventually, they have to raise the interest rates back up because it's causing havoc in the economy. Right now, their goal is to get people to spend money, and that's what exactly they're gonna do. Whether it's a good thing or bad thing, it really depends on your situation. If you take a more financial route, it's a really great opportunity to make a ton of money. In trade, you have to sacrifice something. For example, living in a house and you'll be renting a place for the next couple of years. Then you can buy back in. At the same time, you make a crap ton of money from it if you do it that way. As the people who already have the money, they can, continue buying, and whether they can support it or not, sustain it, it really will depend on that. That's how they manage their money. And as for stocks, real estate, it's a pretty niche topic, but it's really enclosed to a specific group of buyers because you need a massive amount of capital to get into that market. Even if you don't have a massive amount of capital, you can actually leverage how your house works. For example, house hacking, a lot of people talked about it. If you house hack, then you can actually split up your income, your property tax, bills, water bills, damage, all being paid from, or, reduce thanks to renting it out. At the same time, like I said, you trade as privacy. As for stocks, it's kind of interesting. You compare the United States to other countries. You look at Japan, you look at like Europe and stuff. Why do stocks in America like to shoot straight up? Because you look at how do people buy into things here. Meaning is there's a lot of advertisement in America. It's also, you notice that if you pay really close attention and close out all the noise, and you smash the like button down below and subscribe button, you realize this nation is a consumer state. A lot of people like to buy things. So a lot of advertisements will come up and try to convince you to buy things, and a lot of people will buy things, as simple as that. And when that happens, stocks come into play too. So when companies and corporations go IPO, next thing you know, you buy their stocks because they found it as investments. So basically, all those companies in America, and some of them out of the states too, or out of the country, they realize this system. So they all compete against each other for our money. So when we invest into them, we expect a return. And when companies know about that, they work their best trying to get people to buy more of their shares, because the more of their company shares worth, the more they make. So it's basically a mutual benefit at the end. Whether or not a company does well or does good, it really depends on how do people see their products and how much people believe in the company. Look at Tesla. A lot of people believe in that company because that company literally shook the whole market. Literally took a duopoly and they become a monopoly themselves. Monopoly attacking duopoly. In that case, it makes their stocks shoot straight up. As for other players like at Amazon, Google, Facebook, Palantir, the list goes on. At the end, it really depends on what they do and how they announce it to the people. That'll affect how the stocks raise. But overall, stocks will continue to go up in general, because if you look at the trend from when it first started, it's slowly at the beginning, it didn't really rise as much. It basically was pretty flat until you hit around the internet age. When the internet came out, everyone started connecting to each other, and now these days, the internet's gonna get faster and faster and faster, and more people are gonna have internet, so more people will get involved in the financial situation economy. So when that happens, I guarantee you, even the stock market goes down, it's gonna shoot straight up. Watch this video again in like the next decade, I'll say the same thing again. I hope you guys liked this video. Please like, share, and subscribe. I see you guys next time. Peace.